Hey, are you a beginner and are you stuck on trying to figure out what are mutual funds and are they worth investing? In today's video, I break down the pros and cons about mutual funds and whether you should add them to your portfolio. So for the best millennial investing advice out on the interwebs, make sure to subscribe, hit the bell, and to stay tuned for when I drop a video every Monday where I help you make it rain every single Monday. Magic City Mondays, baby. Hey, so I get it. Maybe you're overwhelmed by all the advice out there. People are telling you, hey, mutual funds are good. No, don't do mutual fund, do an index fund. Guess what? There are so much bad information out there. I thought I'd just step in and just clarify everything based off what I know, my experience as well. And by the end of this video, you'll have my 3-step strategy, what I call RPF. And that is how I evaluate whether, hey, should I do this mutual fund or not? And you can use this RPF strategy to help you set up your automated investing machine or kick-ass portfolio. I've used this formula for a lot of my clients and my friends. Now it's your turn. But before we get started, I love to kind of hear, what are your friends and family, or what have you read on the internet about mutual funds? I would just love to kind of hear the rumors, the facts, the things that you're unsure about. Make sure to comment below, and maybe we can do a fun series where I either do a Mythbusters type of thing, whether these are true or false. Chances are I've been in your shoes before. I've heard a lot about mutual funds. I've heard some of them are really good, some of them are really bad, sometimes they're really expensive, they kill you on fees. And typically when you hear investing, you're always thinking stocks, and you're just thinking, oh, should I do stocks instead? Well, in today's video, I just kind of want to break down a few things. There's a few things I'm going to break down, what they are, the pros and cons of a mutual fund, how portfolios are managed with mutual funds, how liquid they are, some tax considerations and fees as well, and my final review whether they're worth it or not. So you might be asking, hey, what is a mutual fund? So traditionally, mutual funds are basically a pool of money where you can take other investors and pool your money together to buy a collection of bonds, stocks, and securities, and create a portfolio that you probably couldn't afford to create on your own. I like to think of it as like a bucket of funds or a basket of funds. People use that analogy as well. Typically, these are run by a portfolio manager. So there's someone in charge or a group that is in charge of this. And there's usually two different types of mutual funds. One are more passive. So like you can get index funds that are mutual funds where it's more computer generated. It's not as active, right? Maybe they'll track like the S&P 500, the top 500 companies. Maybe it's more like the Russell 3000 where it's tracking the whole market, or maybe it's more of an international index as well. So usually they're tracking a certain market benchmark, and that's more of a passive. You'll find lower fees with that. Now, the second alternative is more active management, when you have portfolio managers actively selecting the funds and creating their own best portfolio to beat the market. I'll go into that more later, but just know that. And an important thing to know, when you invest into a mutual fund, you don't actually own that actual security. You don't actually own the actual bond or stock or security that, you know, the fund is invested in, but you own the fund, the mutual fund itself. So that's really important to know. Typically, when I look at mutual funds, I like to do something called RPF. I don't know, I just got it from like a GTL from Jersey Shore, but I thought RPF sounded really cool. And it really comes down to 3 things: risks, performance, fees. Those are typically the things that I'm missing. I might adapt this more later, but you know, that's what I have right now. So let's dive into portfolio management, right? So traditionally, how a lot of brokerage companies tell you this is that there's an added benefit of going with a professional. They have more resources than you. They have better expertise. They have analysts, a whole team of resources to help you out to figure out the best way to beat the market. Now, something to keep in mind, when you have portfolio managers and all these type of things, when it's more active management, people aren't going to do it for free, right? They want to be paid. So there's going to be higher expense ratios or higher operation costs. So that's something to keep in mind. And the second question is, now do they actually do it? If you look at it from a long-term point of usually short-term point of view, sometimes a lot of these funds will beat it short-term, maybe 1 year out, 2 years out. But if you look at a longer term, like 3, 5, 10, 15 years out, only about 1 in 6 beat the market. I think it's about 80 or 90%. Only like 80 to 90% fail to beat the market compared to a market index. So that's really something important to realize. You can find that statistic across the internet. Now, I will tell you this, having a mutual fund saves a lot of time, especially for new beginner investors, because it takes time to research stocks. Maybe you don't know how to read a balance sheet. You don't know what a PE ratio is and all that. It's really confusing sometimes. So these are great for people who don't have the time or expertise to do it. And this goes into the P part when it comes to performance. When you are looking at these, make sure that you really look at the long term of the fund. That way although it's not an indication that you will get that absolute return, it just tells you whether, these people that you're trusting your money with are actually making money with it, or could you get a better return through a more passive mutual fund or index fund as well. Now, second thing, liquidity. Basically, this is what liquidity is. Think about it like water. How I like to think about it is how easy is it for your money to flow, or how easy is it to move your money around? With mutual funds, you can buy and sell once a day at the close of the market. And one really cool thing about mutual funds is that you get dividends. You can either choose to take the cash, which you get taxed on depending which account that you have, or tortilla, how I like to call it in my investing masterclass. But you can either choose to take the money out or reinvest it back for future funds and have your portfolio grow like that. Now, this is a huge pro. Usually the minimum investment amount for a mutual fund is a lot cheaper than creating that same custom portfolio yourself. For example, if you're to buy the S&P 500, rather than buy like Apple, Amazon, one share of each, and 500 other companies, you can actually get the benefit of all that for just maybe, let's say if a mutual fund is $30, $100, maybe $200, whatever the cost is, you can get in at a lower cost. And when you're trying to liquidate it, you don't have to sell from different ones. It just really takes the headache out of everything as well. So that's a major pro. The next thing I like to look at is tax considerations. Remember, like I said, you typically get dividends if you keep your stocks as well. So another thing is managers can actually sell securities. And typically when they sell securities, they actually generate income for the fund, right? And typically these are paid out as periodic distributions. Now, when you are paid distributions, you are taxed, except if they're coming from a certain type of bond called municipal bonds, which don't get taxed at the federal and sometimes the state level. It really depends. Now, I would say mutual funds are really great when you pair them up with a Roth IRA or a retirement account like a 401k or traditional IRA. Just because if you hold it out of the account, there's 3 ways that you can get taxed. First thing is that you get dividend income. When you get dividend income, you're actually taxed at the ordinary income rate or your tax bracket. Second thing is capital gains. So when you sell a mutual fund and you make a profit off of it, obviously Uncle Sam wants its cut. So if you sell it within a year, with the current rules right now, if you sell it within a year, you get taxed. You get taxed at your normal tax rate or your income bracket. But if you hold it on for at least a year, you get actually long-term gains, and it's a special rate. Usually it's about 15%. Really depends. I would tell you look on the IRS website or talk to your accountant. Now let's really take a look at the fees. Fees are everything when it comes to mutual funds because they can make or break you. That small percentage, even if you're getting charged 1%, might not seem a lot, but if you blow it up in the long run, there's a lot of interest rate calculators and stuff. It actually can mean a lot. There's some cases where I've calculated where it can mean like almost $500,000. So really look out for these fees because they add up in the long term. Now there's typically 3 types of fees. There's loads. So you might hear these as front end load, back end loads, They're less common nowadays because it's not really attractive to have these loads, and actually it decreases their sales volume. But it's basically a transaction fee for, you know, buying or selling a stock. So the amount of money it takes to go into a mutual fund. These are less common now, but essentially what a load is are transaction fees when you buy or sell a stock. Sometimes there might be a front end load where they charge you up front to just buy the mutual fund. Sometimes there's a back end load where if you sell the mutual fund, that's when you'll get charged. So I'm not a huge fan of these. Try to find funds that are very low, that don't have these fees. And very possible, especially during these days, because everybody's trying to stay competitive. Second thing is redemption fees. So sometimes certain mutual funds will charge you if you sell your mutual funds within a short amount of time. Think about it. They want to hold your money. They want to invest your money to make more money. So if you only have it for a short amount of time, they might be a little PO'd about it and charge you a fee for that. So just be careful about that. There's also a operation cost, sometimes advisory fees for all the overhead, like I was saying before, transaction costs. The main key thing is look at different expense ratios. Just to give you a point of reference, some of these mutual funds can run to 1% and higher for more active funds. If you take a look at S&P 500 or index funds and stuff like that, you'll see expense ratios all the way down to, I think Fidelity has like 0.015%. Vanguard, it's Admiral investing shares are like 0.04%. Even Fidelity has its zero fee funds as well, which are zero expense ratio, which is really amazing. But if you want to learn more about that, I have a video right here for that. So I know I threw a lot at you. I've taught you how to RPF, what things to look for when you're looking at performance, risk, and fees. Obviously, every single mutual fund is a case-by-case basis, but today I'm going to break down the pros and cons for a mutual fund. So pro, it's a really smart and cost-effective way to invest. If you're trying to mimic the S&P 500, it's a lot more cost-effective to buy one mutual fund at $100 and have a more diverse portfolio than it is to buy every single one of those companies and then adjust if that list changes. Oh my God, that is a headache. So it's a lot easier and smart way to invest your money. Also, like I was saying, it's a great way to diversify your investments, right? Typically, you'll hear this. If you go all in on a stock, you just don't know. It's super risky. You don't know if that company will have a good day, bad day, and so you don't want you don't want to invest all into this company just to have it plummet. So that's really important as well. Third thing, it's logistically a lot easier to buy one fund than 500 other funds. A major benefit that I didn't mention earlier over ETFs or exchange traded funds, mutual funds actually can have automated investments. So if you want a dollar cost average in the long term, that's really, really great. I highly recommend that. Now let's cover some of the cons, right? So when these are not held in a retirement account, they can be quite tax unfriendly. Like I was saying, you can get tax capital gains. You can get tax ordinary income on just the dividends that you get. So really make sure that you try to hold these as much as you can on a within a tax advantage account. Second thing, these are for more active managed portfolios. Typically, these can be very expensive and they don't beat the market. Obviously, every mutual fund is going to be different, but really take a look at the previous performance and make sure that the people that you're trusting your money to are going to beat the market. It's hard to predict, but I always recommend, hey, start off with some more passive index-based mutual funds as well. Now that's pretty much all the cons that I would probably say. All right, so now you know exactly what mutual funds are. You're probably wondering, hey, what are some really great mutual funds? I'll leave a video right here comparing top Fidelity and Vanguard index funds, so you can take a look at it there to fill up your portfolio. But maybe you're even wondering, hey, do I have any other gaps in my portfolio? I guarantee you do. Say no more, fam. I'm here. I'm here to plug in your money leaks for your kick-ass portfolio. I actually created a 12-point checklist, investing checklist, to help you plug in your money leaks, to help you make more passive income, to increase your returns on your portfolio for absolutely free. Link is below in the description. Also, if you're interested, I actually included a free kick-ass masterclass on how to set up and automate your Roth IRA just over the weekend. Make sure to check that out. And finally, now that you know what mutual funds are, I love to kind of hear from you. And if you like this video, make sure to like, comment, subscribe. Make sure to share this with your fellow kick-ass investors. It would really help my channel grow. And comment below whether this video was helpful or not. I would love to learn from you. So finally, I love to hear from yourself. Now that you know what mutual funds are, what's next? What are some of the mutual funds that you're looking at? Please put them below in the comments and let's share this community. All right, that is all. Kick-ass Kevin out. And thank you guys again. Talk to you guys later. Stay investing with other people. Woo!